Welcome to Building Strong Capital Stacks to Finance Growth. This session is presented by Fifth Third Bank. Let's meet the panelists. First, welcome Terry Ziegler, GM, Retail TPX, Blacksmith Applications. Next, please meet Paul Powers, co-founder and CEO of Physna. And finally, Joshua Sosland, Managing Director, Fifth Third. Moderating today's session is Jeremy Gutierrez, Senior Vice President, Commercial Banking at Fifth Third. Jeremy, the virtual stage is yours.
Good morning, everyone, and welcome to our session at the 2021 Dealmakers Conference. Today, we've got a panel of experts that are going to talk about building capital stacks to grow your business. And we're fortunate to have some experts on our panel, Paul, Terry, and Joshua. And at this point, I'd like to turn it over to Paul, Terry, and Joshua to introduce themselves, give a brief background on their experience, and then we'll get right into the session. Joshua, let's start with you.
Thank you, Jeremy. Again, my name is Joshua Sosland. I'm part of Fifth Third's debt capital markets team. I have 25 years of debt capital markets experience, 3 of which most recently with Fifth Third Bank.
Why don't we move over to Paul?
Hi, I'm Paul Powers. I'm the founder and CEO of Physna. We started in 2015 and have been growing ever since then. I've been running tech companies since for the majority of my adult life, but ever since 2015, it's about 6.5 years now. My focus has been exclusively on business specifically.
Very good. And Terry?
Yes, good afternoon, Jeremy. Appreciate everyone on the call today. My name is Terry Ziegler. I'm the general manager of Blacksmith Applications. I actually came to Blacksmith via an acquisition and merger back in 2019. I have been in the technology business for about 15 years. Prior to that, about 20 years in consumer packaged goods. So took some of my domain expertise and founded, built, and sold a company.
Paul, Terry, Joshua, thank you so much for serving on our panel. My name is Jeremy Gutierrez, and I lead our commercial banking team for Fifth Third Bank in Central Ohio. Been in commercial banking for approximately 27 years, and let's go ahead and kick it off. Panel, is that okay?
Let's get started.
All right. Joshua, I want to come to you with a question first. Thinking about current market trends around financing growth, we're certainly not here to tell everyone every possible way to finance growth. Rather, we'd like to provide some insights around different strategies, different approaches that all of you have leveraged and been successful with. So Josh, my question for you is, what new avenues or capital stack structures for financing acquisitions should our audience or executives be thinking about in today's environment?
Thank you, Jeremy. And while it's a direct competition for the traditional bank loan market, I would be remiss if I didn't speak about the growth of the private credit market and specifically the unitranche market. For those of you in the audience who are not familiar with the unitranche product is a credit facility that's typically provided by a single credit provider, whereas a loan syndication is provided by a group of lenders. This market has really grown over the years. Year to date, around a third of the deals done in the middle market leverage loan space have been done under the unitranche product. And the unitranche product, started off as being, financing very relatively small leverage buyouts. But over the last 18 months, we've seen those capacity constraints really dissolve. And in fact, in the last 18 months, we've seen 24 unitranche deals that have been done for $1 billion or more. And why do equity sponsors like unitranche products? First, I would say is ease of execution. You're negotiating all your loan documents or term sheet with a single credit provider. Second, there's no flex, so that when you sign up the deal, you know what you're going to get at close. There's no need to go to the rating agencies. And nowadays, it's being done more and more on a covenant-light basis. So those are the positives. Now, on the negative side, it's awfully good to have negotiations with one credit party, but that credit party can exert a lot of control and influence, whereas under a loan syndication product, you're negotiating the deal with a group of lenders. This product also is a little bit more expensive when compared to a traditional loan syndication product. Although we have seen that pricing come in, And finally, I would say, the unitranche product has become mainstream, but it really is reserved principally for equity sponsor related deals. We've seen a handful of deals get done in the corporate space, but it's primarily used by equity sponsors to finance their transactions. So it's a good and growing product, and we're going to see it continue to grow in the future. Thank you, Jeremy.
Thanks, Joshua. Paul, I want to come over to you. A little bit different twist on the question. Same question, but as it relates to the equity market, and perhaps you could share some of the successes you found when leveraging venture capital to scale your business.
Absolutely. So if you think about what Physna does, it's a new technical primitive that turns physical objects into code so that you can search them and analyze them just like digital information. The reason I share that is it's pretty clear when I explain it. It's a very capital intensive endeavor. And to do that, you need funding long before you would traditionally be eligible for it. And so VC funding has provided us what the means not only to build what's necessary from a technical perspective to get there, but also the infrastructure to make this product scale. And before raising VC capital in particular, we couldn't afford to fully implement our strategy. And part of that strategy is to index all the DNA, if you will, of physical objects in the world. And that's extremely costly, but it's also a core part of our business strategy. And so being able to, over the past year, we raised 76 million. We've raised 86 million in total since we launched the company. And that VC capital has allowed us to grow leaps and bounds over the past 18 months.
Yeah, very good, Paul. Paul, if you don't mind, I'd like to maybe dig a little bit deeper with your answer. What have you and the company done in your experience to get on the radar, kind of create visibility around your firm with the various VC funds?
Well, there are a couple of things we've done. I mean, one is we've created something that's truly unique. I mean, what Physna does is it's the first kind of product in its own genre, right? It's a category creating product, and that itself raises some interest. That's part of a larger trend towards 3D technology. We hear a lot about augmented reality these days, et cetera. The other thing that we've done is we launched something called thanks.com, which is a consumer level application of Physna. It's a lighter application, but it's free. And that's grown tremendously. We have hundreds of thousands of monthly users. We have millions of people use the site. And it's essentially like a Google for 3D objects. And it's actually, I believe, the fastest growing 3D model community in history. And it's only been around for about a year now. So all those things together, the rapid growth, the unique technology, the core capabilities that other companies can't copy or master yet, that's really drawn the attention to us, more so than us trying to go out and look for attention.
Got it. Thanks, Paul. Terry, I want to come over to you when we, again, think about the different capital stack structures that can be leveraged to finance business growth or acquisitions. As a buy-side minded executive, what should you be thinking about if you're in the audience and you're in this position?
Yeah, thank you. What it really, the things that I've seen and what I've experienced is really where you are in your maturity cycle. So like mentioned earlier, I mean, when I started my company, I went VC and then ended up private equity back. But at the end of the day, it's like, if you've got private equity backing you right now, so you have an opportunity to raise funds through that method. So what is their investment horizon and their growth goals? And, is there still some opportunity for them to grow before, kind of that next big transaction? So I've seen mezzanine debt, or warrants being used. You also have to be concerned a little bit about the dilution pressures. Obviously, that was important to me at the beginning. But as we've grown and as we've merged, there are other things that have also come to light. And that is, combination of using existing assets. So is the balance sheet pretty healthy, whereby you can support some of that M&A activity off your own balance sheet, plus some of the debt that was talked about earlier, and using that kind of a combination of that, understanding what those covenants would be, obviously to qualify. But those are a couple different areas that I've had exposure to, as well as if you're going out and acquiring a company that might be a good target for you. What does that look like relative to rollover of capital from the people that you're acquiring it from, including founders, upper management, things like that? They may be along for the ride, longer term that might be able to roll over some of that capital and actually finance part of that debt or that transaction cost.
No, very good, Terry. Great words of wisdom there. This next question, Paul, I'm coming to you, but Terry and Josh, certainly feel free to add any color commentary as you see fit. Paul, you mentioned with Physna kind of being an early stage company that you've grown, obviously, and scaled. In securing that early stage capital, again, in your experience, how vigorous or rigorous, I should say, is that vetting process that's taken place with the different equity funds that you've been working with? And is that something that's changed in the last, call it 18 months with the pandemic rising and rearing its head?
Certainly. So with the pandemic, it's been harder to meet with people in person. Unlike in the past, we would fly out to California or to New York and meet with VCs left and right. Now it's all very virtual. The vetting is still it's still very real. I mean, it's much more rigorous than angel investment vetting. Private angel investments, their vetting typically isn't very thorough, but venture capitalists, they want to know that what you have is real and that the potential of your product is really great. As far as what else has changed in the past 18 months is we've seen more capital available to VCs. So there's been a little bit of a shift in the balance because there's only so many startups. There's only, one of any given startup, but there's a lot more capital to invest. And so that's made it more important for VCs to differentiate themselves. So part of the vetting is not just a one-way street. It never should have been, but it used to be a little bit more one-sided. Now, over the past 18 months, it definitely feels like it's shifted more towards a two-way vetting process. Not only do they want to know that you're worth investing in, because there is a lot of capital in the market right now, you want to make sure that you're choosing the right VC for you. So ask questions like, how does this VC differentiate themselves? Capital is capital. It's not a differentiator. So how are they going to interact with you as a founder? Will they support you or distract you in running your business? Things like that become key when determining where to actually source the capital from.
No, very good. Joshua, Terry, anything to add to that?
Well, I'm kind of shaking or nodding my head because you're absolutely right, Paul. I mean, when we were looking at additional funding and looking at private equity as well, it's like, okay, the money's out there. I mean, we'll talk about it, I'm sure, a little bit later, but there's an abundance of the capital. So what sets you apart? I mean, how are you going to help me grow? So I'm going to need resources, whether it's HR type of resources to go out and find additional help or those types of leadership positions to, getting me ready on the development side if I need some of those different resources. So it really is, are you going to roll up your sleeves and be a partner rather than just a financier? That's a great point you made, Paul.
Joshua, the only thing that I would add is, again, obviously pre-pandemic, we were very actively meeting with companies, doing hands-on due diligence. But, to Paul's point, we've adapted pretty well to doing things over Zoom or WebEx or other ways to facilitate the interaction and making sure we're getting the proper due diligence done when we finance companies. So we're just starting to do a little bit more in-person meetings, but I don't think we're going to go back to the old days where, you had to spend a day constantly on the road doing the due diligence. Hopefully, I think going forward, we'll be able to accomplish some of this due diligence via technologies, principally Zoom and other video types of mechanisms to interact with management teams and private equity firms.
That's a great point. And I think the discussion we're having right now is a testament to how we are continuing to evolve and we still can get business done.
Yeah.
So I want to move on to the life cycle of a deal. Certainly, we've all been a part of a deal where you've got that 11th hour change, pivot, you got to call an audible. And oftentimes that deal we find comes back and resurrects itself, albeit maybe in a different light, different terms, different structure. Can each of you talk about deals that you've been a part of that maybe fit that description and how you were able to persevere and what maybe some key characteristics and activities were that allowed you to ultimately move forward and get that deal done?
Sure, I can start. I mean, so in my space, or in particular on the technology side, it tends to be kind of the founders and I'm sure the founders and the management team in any kind of a transaction are a big key. But in ours, it's that kind of that IP and domain expertise. Does anybody get, or do they get a sense, the acquirers get a sense that the founding team or the kind of that leadership isn't going to come over and get cold feet of doing that. So I've seen that happen before. I've seen the IP go through a rigorous diligence that may lead itself to, is it protected enough, and to maybe have to dig a little bit deeper. So I mean, the biggest thing here is really the big watch out in all of this 11th hour and resurrection piece is making sure you don't lose focus of the business, because the last thing you want to do, I mean, raising capital, selling a company, merging and buying other companies. I mean, my gosh, it's just so distracting and so disruptive. So you can't lose focus of that.
Terry, that's a great point you make about leaning into the resources that we have available to us when putting a deal together.
Yeah, and there's one other point that I wanted to make, and this is something I've experienced before, and that is, during the negotiations and during the process and the diligence, there are going to be some bumps in the road, no doubt. I mean, every time I've been through this, there might even be a time where you think the deal's not going to happen. But depending on if it's a true strategic transaction and partnership that's taken place, that you're going to have the legal teams trying to work the best deal for themselves and for their clients. You're going to have the IT and the finance teams doing the same thing. But at the end of the day, if you can get, the business, I call them the business leads, so the CEO, if you will, of each company, have that kind of that after hours call, that telephone call to say, you know what, this is really important to both of us. We can really grow together, and we got to figure out a way to make that happen. And then you go back as those business leads to your individual groups and say, we've got to make this happen. And here are all the reasons why. You guys you guys need to bend on this or bend on that, and both sides need to go through that activity. But at the end of the day, this is a business transaction. Yes, you have a legal team, you have a finance team, you got the the financiers. But at the end of the day, I mean, we're the leaders that have to take this company from X to Y and those that growth curve for the next kind of evolution of the company.
No, well put, Terry. Paul, any further thoughts on that?
I think that when it comes down to the 11th hour of a deal, the important thing is communication, right? If you both know what is important to the other side, and you're willing to work with that to assure that the deal actually gets done. We haven't had a whole lot of issues with this, to be totally frank. We've had a couple of deals that got really close and then didn't work out. But typically what we see are, I can give you an example that's a different type of a deal, but I think the same principle applies. We had a customer who signed on, so this would be like a 13th hour thing almost. And it was right when COVID was starting to ramp up, and they didn't realize, they didn't know what would happen. Right after they signed on onto our program, they ended up having to furlough a bunch of their workers. And it took a year for that deal to come back to life, and it finally did just last week. And the way that we kept that deal alive was just by staying in touch and working really, really closely with them and showing them that we also have their best interests at heart. We acted in good faith, and then when the situation improved, so did the customer, right? So I think when it comes just about anything in business, showing that you have goal alignment and showing that you're ethical and willing to work through whatever the issue is will yield the best results, especially with customers, but even with investors or investees or other types of deals. I think as long as you're just right, then they'll view you as someone they can support, be willing to go extra mile, get the paperwork cover a decision.
And Paul, you bring up a great point around communication. I think whether it's on the professional side or even on the personal side, communication is always critical to getting things accomplished. Joshua, I know as bankers, we've never hit the 11th hour and had a deal change on us. Any thoughts from your perspective?
I would simply add, Jeremy, I know you and I have been involved in countless deals where the due diligence doesn't substantiate the projection. So, we've both been involved in situations where, sometimes the deal simply falls away. There's a reduction in purchase price. But in a lot of the deals that I've been involved more recently where there was a problem with the due diligence, more of a portion of the purchase price has been placed into an earnout so that the sellers are getting the same purchase price, but they have to earn their way to the total purchase price. So I think it's a fair accommodation if for whatever reason the sponsor or the purchaser, has trouble substantiating the projections of the underlying business.
Yeah, very good. And Joshua, would like to stick with you. And to the point of the original question, certainly as we're going through the process of looking at a deal, sometimes red flags pop up. And from the lens of a financier, what are some of those red flags that may pop up that give you pause and certainly, elicit the need to have further discussions with the buyer or seller?
Yeah, so I think that's a good question. You and I deal with more, I think, in many instances, more mature companies, unlike Paul and Terry, who are in the nascent stage of their development. Jeremy, one of the things that, causes us pause is typically companies who have trouble generating financial statements and those financial statements on a timely basis. That's kind of a red flag that they don't have the systems in place to kind of manage the business going forward. The other issue that we can run into oftentimes is companies that are just simply growing too fast. I was recently involved in a situation where, we had an existing relationship. A company had made a series of acquisitions over time, but really had failed to integrate those acquisitions properly. They came to us, they needed more capital for growth, but we had a pretty constructive conversation between the bank and the borrower and say, look, we want to help you continue your consolidation of this industry, but beforehand, you really need to integrate these acquisitions. And that meant getting them on the same accounting platform and really also hiring the human infrastructure to manage a larger and more complex business. So once that was done, and it was done in a relatively short period of time, we were able to come to terms on a new credit facility, one that not only refinanced their existing indebtedness, but also gave them the additional capital to continue to grow and consolidate the underlying industry.
Joshua, thanks for that view from the lens of the financier. Paul and Terry, coming over to you, we'll put the hat of the buyer and or seller on in an acquisition. What are some of those red flags that would give you pause for concern, or at least, you're hitting the pause button to really, really dig deeper on your due diligence? Let's go to you first, Paul.
Well, we haven't seriously considered acquisition offers that we've been receiving in the past few years just because we are growing so quickly. We have had some strategic discussions around buying other businesses in the future. The main criteria for us has been, that there's one, strategic alignment, and two, that we have a plan to integrate following the merger. A really great point that was raised with integration. I think I can't agree with it enough. We see with a lot of our customers a pretty big issue when they acquired other companies in the past, and that is that we often find, again, because we work with 3D data and parts, very, very high numbers of duplicates and CAD drawings when one company acquires another, and different systems for tracking them. And that means that it's a double-edged sword. If you take action on that, there's a great opportunity to save money and procurement and increase time to market and engineering that companies just aren't realizing. And I think the other side of it is that a lot of companies don't realize that having those duplicates there, having that non-integrated data, actually has a profound negative impact on their supply chain processes and spare parts processes, and just about every aspect of the business gets affected. So if you're going to acquire a business, or have already done so, looking into data and processes, I think, is crucial to take full advantage of the opportunity that M&A gives you without realizing the risks that it can give. And that's something that we take into consideration when we look at potentially in the future acquiring a business. But we haven't been on the other side of that. We just haven't been interested in selling yet.
No, very good. Terry?
Yeah, and those are great points. I mean, I think it all comes down into the diligence side. I mean, either side, the buy or the sell. But at the end of the day, it's everything from quality of revenue to customer references. So we'll do a fair amount of those. Again, I've been on both sides of that. So if you're running into customers that are maybe a little indifferent or things like that, are tough to get a hold of. But it really comes down to some of the diligence items where there's delays or difficulty getting some of that information. And then I think the last, there's always an eagerness to close. So yeah, if you're eager to close, then we need these items here, by this time. So those are things that kind of give you a little bit of pause. and then of course, I think one of the most important things, though, again, I mentioned earlier, was the kind of the founder or management team, that kind of that IP and domain expertise that's been built over the time of the acquired company. Are they going to be in the game moving forward? And is there some creative ways? Earnouts can get a little bit tough, but are there some other incentives for them to roll some of the capital over into the new company, not necessarily as an earnout, but kind of that partnership of growth.
Very good. Paul and Terry, just a quick follow-up to both of your answers. What do you think the role of culture plays when considering an acquisition?
I'll go first, just because it really that's an interesting thing, because when I was selling my company, there were a few suitors involved, and it got down to getting the LOIs in place. And the terms were pretty similar. There were some variances, but it's kind of funny. I had that conversation with the chairman of my board, and really that was something that was asked amongst the two of us, and that is, are your two companies going to be able to merge well culturally to that? Because there were some that were, I didn't know, I'd met the management team and things like that. So I wasn't sure if that culture fit would be as good as the one that actually acquired us, which obviously turned out to be very well. But that's a great point. I think that's super important as you go into some kind of a merger activity like that.
I would agree. I think culture is key, and without culture, your company has nothing. With a great culture, your morale is high, and with a bad culture or a lack thereof, it's low. And one of the main things that kills mergers, at least from what we've seen, is a lack of cultural continuity or a lack of compatibility between cultures. Yeah. And one thing that we would definitely look at if we were acquiring a company right now, which we might be doing in the near future, is can our companies coexist? Do they have similar principles? Do the people think similarly to how we think? It can be potentially, not only are you not adding to the existing culture that you have, you're potentially detracting from it by bringing in a foreign element that is reshaping the culture into something that you don't want. It's like you're adding two ingredients together. Maybe on their own they're nice, but if you put them together, does it create something that tastes awful, right? And that's an important aspect of any merger. At the end of the day, companies are people, and culture is the sum of how they operate together. I think it's absolutely one of the most crucial and potentially one of the most overlooked aspects of a deal.
Yeah, great point, Paul. Terry as well. Thank you so much for sharing your thoughts there. So let's look to the future. None of us have a crystal ball, but we'll do our best here. Josh, do you expect the cost of securing growth capital to go up in 2022, or do you expect the supply of cheap capital to remain?
Jeremy, as we look to the fourth quarter from a bank loan perspective, I think it's probably going to be one of the busiest quarters on record through a combination of both M&A and dividend activity. From our perspective, I think there's a little bit of uncertainty around what's going to happen with some of these potential tax law changes. So we are, I think, pulling some deals forward that would probably occur in the first or second quarter of 22. So we're anticipating a very robust fourth quarter. With that said, the outlook for the market for 22 remains strong. I mean, rates remain very low. There's a lot of money on the sidelines right now, and companies continue to perform pretty well in a difficult environment. So we're very optimistic that things are going to stay very robust. Capital is going to remain cheap, and as long as companies continue to figure out how to continue to navigate what I think is a very difficult environment, I think there's going to be capital available to those companies, and capital is going to be at a very attractive rates.
Yeah, well put. Paul, same question, but a different twist. Certainly a lot of liquidity out there in the system right now. How do you see the role of venture capital or private equity groups changing, if at all, as we move forward?
I think successful VCs are going to have an awesome opportunity for massive earnings, since they have enough capital to fund promising companies with enough capital to make them successful. in certain situations, I think underfunding a company can be almost worse than not funding them at all, because they can lead to these half measures that founders take that are neither the safe route nor the full plan, and they don't really lead you anywhere. So the best companies, I think, got there by having enough capital and deployed wisely enough to fully execute their full strategy. That doesn't mean that you're wasting money. It just means that you're carefully investing that capital into well thought out strategies. And I mentioned successful VCs because I think that there are a lot of VCs that are going to find that having capital, as mentioned before, is not enough to secure investment into startups. Reputation that your firm already has is one aspect, one part of the game, but founders want to know now that the VCs not only understand the strategy, but that they'll support with more than just the cash. They'll support strategically, but they'll be, and very importantly, they'll be supportive to the founders. They'll be helpful to them. It takes everything out of you when you run a company. It's a very more than a full-time job. It's a lifestyle. And VCs that don't realize that they have to have those relationships, they're going to have a very difficult time investing in the companies they want to, because if there's only so many of the startups, but there's a growing amount of cash, almost limitless amount of cash. Mm-hmm. So the companies that have choices, they're not going to take the money from a VC that does not have a stellar reputation for working together with founders, meaning that VC won't be able to make the best investments, and then their performance is going to fall apart as a result. And you see sites coming into play now like VC Guide, which is essentially a reputational guide for how is it to actually work with this VC partner. How are they in board meetings? Are they supportive or not? Mm-hmm. And trust me, founders who have options are really going to care about who they're working with. They're going to ask each other about what it was like to work with that VC. I get asked all the time by different startup founders who might already have offers on the table from VCs, what I think about them. And I did the same thing when I was raising money. So I think that to be successful, VCs are going to have to win at that game. And that's going to be how their role starts to evolve. That's going to be more of a two-way thing. And the VCs are going to have to do more than just have good ROI on their investments. To continue that, they're going to have great relationships with the founders so they can keep investing in the best companies.
Great insights there, Paul. Terry, anything else to add to that question?
Yeah, I agree with everything Paul said, and that goes back to that value add of the VC or even the private equity firms. And the other thing, in addition, I kind of think it goes along with it is, that initial investment capital is great, but how about the follow-on investments? Do they have the stomach for that, and are they willing to put more capital into the business to actually see it grow? And I think this is a great opportunity for that. And as far as the funds growing, the actual VC and private equity funds, I see those growing at pretty good rates now as well, just given the fact of what the market's doing and some of the returns that we're seeing in our space.
Very good. Well, last question, and we'll go ahead and lean on your experience and your expertise on this one and look for some best practices for you to share with our audience. Can you share maybe your wisdom, 2 or 3 important considerations for our audience to take into account when they're contemplating what that optimal capital stack should look like, whether it's to finance business growth organically, whether it's to make an acquisition, what have you, to accomplish their growth strategy? So maybe 2 or 3 important things that you consider to be paramount when looking to grow your business and how you're getting there. Let's go ahead.
Jeremy, this is Josh. I think I'll take a quick shot at this question. The one thing that I think I want to touch on is just simply transparency. From my perspective, I think it's important that you talk to your financing sources about the good news and the good things that are going on with your company. But, be very forthright when you're talking to your financing sources about things that aren't going well, because we all know that there are going to be bumps in the road. So I think from my perspective, companies that are most successful in establishing long-term financing sources are those companies that are most transparent and willing to share the good and the bad that's going on with their companies.
Thanks, Joshua. Paul?
I think that's a really great insight, and I 100% agree with that. I would add that when it comes to the planning, always start with your end in mind. Does your company need lots of capital? Does it need it right now? Is it better to wait? When you price deals, what's the best structure for your company, not just this year, but long term? I think that one thing that I've learned is that you can't just copy paste every practice from other companies unless what they're doing lines up with your long-term plans for your company. Even then, look for the best practices. If you look at one startup and say, oh, they raised from this fund and then from that fund, that's certainly useful information, but always make sure that you take what approach makes the most sense for your company specifically. Companies have, there are definitely guiding principles that apply to all companies in some ways, but I think one thing that I've learned over the years is that the greatest companies in history all had one thing in common, and that is that they didn't have all that many things in common. They played to their strengths. They created strategies that were different because their businesses were different. And sure, there were some underlying themes and repeatable techniques, but the real lesson is that you need to take time to work out a powerful strategy that's right for your business. It's rarely 100% identical to that of another. So if someone asked me, hey, Paul, how can I raise the money that you raised the way that you raised it? My question would be, do you need to raise that money? Do you need to raise the way that we raised it? Or is your company built differently? And do you have different goals, which might be less capital intensive or perhaps even more so?
Thank you, Paul. Terry, bring us home.
Yeah, the only thing I'd add, I mean, it all comes around strategy and your growth objectives. I mean, at the end of the day, where is it that you want to be? Where is it you want to be for your shareholders as well? Because sometimes, some of those decisions could be out of your hands. So where is it that you want to be and what's it going to take to get there? Is it organic and you have to, invest that way, or is it through M&A? So, what impact is that on your shareholders as well as the founders and management team? And then, of course, through the lens of your own financial health, where are you today? And the one thing I will say is, early on, you couldn't raise enough back then, but to Paul's point, you got to make sure that it works for you. To meet those overall growth objectives and that kind of that final goal that you're looking for.
Very good. Joshua, Paul, Terry, I want to thank you for serving on our panel. I know our audience is leaving with a ton of insights, a ton of value. Thank you for sharing your expertise and your experiences with them. At this point, we're going to move into the live Q&A session. Hope you all in the audience hang around and ask us some questions. Thank you.